Welcome to The Explainer. Today, we are diving into a massive paradigm shift that is completely reshaping how financial software is actually built. We're looking at a world where federal regulations and bottom lines are literally always on the line, and where the old rules of tech development, well, they simply don't apply anymore. If you're involved in building, managing, or scaling financial products, understanding this paradox, and specifically the rigorous requirements gathering needed to survive it, is absolutely crucial. So, here's a question to kick things off. Why on earth does it cost a traditional incumbent bank up to £150 to acquire just one single customer, while a nimble neobank can pull it off for around 20? It's a staggering gap. We really need to unpack how legacy architecture is holding traditional banks back and creating this bloated cost structure, all while fintechs are scaling rapidly and, more importantly, efficiently. It all comes down to a fundamental difference in how these organizations operate at their very core.
We've got a packed agenda today. We're going to cover the FinTech CX advantage, optimizing for survivability, measuring meaningful metrics, product-led growth, the future of Agile, and finally, balancing innovation with compliance. Let's jump right in.
Section 1. The FinTech CX advantage, legacy rigidity versus digital agility.
Picture this. On one side, you have traditional banks throwing massive, bloated budgets just to keep the lights on. I mean, they're anchored by 40-year-old COBOL mainframes. We're talking about software that is literally older than most of the developers maintaining it. Every single time they want to add a feature, it introduces immense complexity and risk. Best case scenario, they might manage one software release a month. Now contrast that with neobanks. They're built entirely on cloud-native APIs and microservices. They're deploying AI for real-time personalization, and they safely release code to production tens of times a day. It creates this frictionless, real-time onboarding experience that legacy banks honestly just can't touch without a massive overhaul.
Moving on to Section 2, Optimizing for Survivability, the Reality of the FinTech PM.
Not user obsession, but failure containment is the real KPI. Wow. Let that sink in for a second. This hard-hitting quote from our sources perfectly summarizes the modern FinTech mandate. It is a completely different mindset from standard consumer tech. In FinTech, you don't really own the roadmap as much as you steward it through incredibly strict layers of regulatory control. Your job is a dual mandate. Grow user value, for sure, but crucially minimize the surface area for regulatory penalties.
Think about it like this. A traditional Silicon Valley PM is obsessed with boosting engagement, right? But a FinTech PM, they're optimizing for survivability. You can't just write a simple, as a user, I want user story and call it a day. Take an international money transfer, for example. Your requirements gathering has to meticulously map out hold states, KYC checks, immutable audit trails, and general ledger impacts. Instead of standard backlog grooming, your real value actually shines in exception handling. If you can't map a user story directly to a balance sheet impact, you're honestly just not ready for this role.
Let me give you a real-world example from our research that perfectly illustrates this. A PM at a fast-scaling neobank shipped this brilliant one-click savings feature. It was a massive hit. It boosted opt-ins by 37%. Incredible, right? Actually, no. It was rolled back just 2 weeks later. Why? Because internal audit flagged it as a potential UDOP violation. That's an unfair, deceptive, or abusive acts or practices violation. This right here is exactly why rigorous stakeholder management during requirements gathering, making sure you involve legal for UDOP and finance for those ledger impacts, is totally non-negotiable. User benefit is always bounded by a financial institution's risk tolerance.
Section 3. Measuring what actually matters, moving from vanity to reality.
$5 to $25. Now, you might be wondering what that number means. That is the hidden cost of KYC, Know Your Customer, and AML anti-money laundering compliance per single customer. When we talk about customer acquisition cost in FinTech, you literally cannot just look at marketing spend. If your onboarding funnel has a 40% failure rate, your $40 marketing acquisition cost suddenly balloons to $80 or even $120 per actually funded customer once you factor in these rigorous compliance checks. It completely changes the game on how we have to calculate unit economics.
So we have to forget vanity metrics like app downloads. High-quality requirements gathering directly impacts the gritty operational KPIs you really need to care about. If your requirements are sloppy, your AML alert to conversion rate is going to skyrocket with false positives, which wastes millions in operational costs. And things like reconciliation cycle time and payout latency, absolutely vital. With the rise of real-time payments today, a 24-hour batch cycle is just unacceptable. Getting your requirements gathering right ensures these complex back-end operational metrics translate into a flawless front-end customer experience.
Section 4. Product-led growth in banking, embedding value in the product.
How do we bridge this massive gap between compliance and engagement? The answer is product-led growth, or PLG. This is a go-to-market strategy where the product itself actually acts as the primary engine for acquisition and retention. By moving away from those clunky, traditional outbound sales-led models over to PLG, financial institutions can tap into behavioral data, usage-based pricing, and embedded growth loops. The whole goal is to deliver seamless value right inside the app, empowering users to discover features completely on their own without needing a human to guide them.
Pulling this off in a highly regulated environment takes 4 vital steps. First, you have to assess your digital-first use cases. Second, modernize that tech stack. You have to move to API-led architectures because, let's be real, you cannot do PLG on a rigid mainframe. Third, and this is a big one, align cross-functionally. You absolutely must break down those hierarchical silos so that your compliance teams transition from being the classic department of no into actual strategic enablers of fast, safe innovation. And finally, launch and iterate using your data.
Section 5. The future of Agile, beyond Scrum and Kanban.
We are finally moving away from just blindly shipping features for the sake of velocity. Because building the wrong product fast is still a massive failure. Instead, leading organizations are leveraging continuous discovery or dual-track Agile. This means discovery is running in parallel with delivery. You're constantly validating ideas and prioritizing via data and stakeholders long before a single line of code is written. This ensures your strict regulatory requirements are baked in from day one.
This end-to-end agility is powered entirely by high-quality requirements. In fact, leading teams today are even using AI tools like Google Gemini to help draft incredibly rigorous acceptance criteria. Then, when it is time to code, combining DevOps with Agile through CI/CD pipelines creates a true test-driven development environment. When every piece of code is rigorously tested against those AI-assisted UX and compliance constraints automatically, you can safely deploy tens of times a day without, accidentally triggering a false overdraft cascade or a massive AML breach.
Section 6. Balancing innovation and compliance, executing the FinTech strategy.
It's really critical to understand the distinction between a product manager and a product owner in this highly regulated space. While the product manager focuses on broad market fit, the product owner is actually a strategic leader in their own right. They shape the future of the product through meticulous requirements gathering. By translating the big vision into rigorous user stories and immutable audit trails, the PO ensures precise, compliant delivery. True success requires both the visionary PM and the strategic PO working hand in hand to navigate these realities.
As you wrap up this explainer, I want you to take a hard look at your own growth strategies, your legacy systems, and your team structures today. And I'll leave you with this final thought to ponder. Is your product roadmap built purely for engagement, or is it built for survival? Because in modern fintech, if it's not built for both, you're already falling behind. Thanks so much for joining me, and keep learning.